good evening. Today is Saturday evening, 6 p.m. So, as you might know if you're in the Discord, if not, you don't know. Today is the questionnaire day. I don't always answer questions on Saturday, but if there's been questions filled in, I will be answering those. For today, I have an overload of questions. I'm not able to answer all of them. I'll just be answering one of them because it's quite comprehensive, the answer. And I've prepared this time for this question. I won't be raw dogging it and just talking about it. I've made some bullet points, things to remember to bring up, and we'll go through all of that. It's quite a lot. So I've divided it into three sections. The question today is from the questionnaire. This one right here can talk more about wars, about how wars affect countries, for example, the USA and Venezuela. I won't be going too much into the United States and Venezuela specifically. I understand what you mean, why you're asking that, because it is a current event that's much in the news. It is mentioned a lot on headline risk, but rather I'll try to give you a general understanding of how wars affect the market when you're trading. Today we'll be talking about conventional wars. Mind you, not trade wars. That's something I mention quite often, that trade wars, conventional wars can have a very, very similar effect when you're trading, just due to the uncertainty of all of it. But with that said, let's just get to it. I've made some bullet points. We're going to go through all of them, and I will be explaining. First of all, stage one is what I call the shock or violent volatility phase. We've got a pretty good representative candle of what I'm talking about here. So what I wrote down is sudden repricing of uncertainty. So what does that mean? Sudden repricing of uncertainty. When there's a sudden repricing of uncertainty, the market chooses a direction pretty violently, very similar to what we're seeing in the candle right here. Very strong movements that pull the equilibrium completely out of what it was. When that happens, for example, because you asked about America and Venezuela, that would most likely affect certain currency pairs, especially the dollar, in a very strong way. So the ranges we have would be blown out. We'd see movements. Let me find something very explosive. Yeah, we could see something like that. Like this, for example, right here. Things going down the shitter. More violent candles as well. Because the market reacts to the uncertainty. So it doesn't really know where to go, where to end. And it's pretty chaotic. We saw that last time. It wasn't war, but with COVID, the market was reacting really wildly. I was trading all through COVID, and currency pairs were doing pretty crazy stuff here. Let me give you an example. It is the shock factor in general. It is the same thing, right? Like right here. So here we're in the COVID period. Let me bring it up full time. And we have some pretty violent movements, pretty strong ones. Stronger in other pairs than this one. For example, here you can see the range is completely wild compared to what we're used to. Like here, it's more tamed now. And that carries with it a lot of extra risk, especially, so note it down, not on this one, that's for later, is there's this liquidity gap that adds to weekend risk. So let's say then, for your question, that the United States announced a full-scale invasion of Venezuela. That would make it a lot more risky when you're trading to hold things over the weekend, doing Friday entries because of all the volume hopping in. You risk getting gapped, especially with the or not getting filled. Sorry, not getting filled through gaps. Gapping is when the opening price is different from the candle close because there's a gap in it. There's not liquidity to fill it. You'd be more likely to see that. It would be more risky in that initial phase to hold pairs through weekends. So you'd have to trade a lot more carefully. But at the same time, it would be a massive BO market with our strat. You'd see trades like these all the time. All the time. And in that sense, it is very nice. And as I've mentioned here, the direction is very unreliable. It could change. There could be talks about it ending, investors thinking it ending, the investors thinking it's getting worse, SPY reacting negatively. That would drive up dollar demand. As you know, SPY is sold in dollars. So we'd see an effect on all dollar pairs. And war is generally, like I've outlined here, I found this, it's not too up to date, but how SPY reacts to different events that are related to war. Everything here isn't conventional warfare, but you can see that it pretty much universally reacts negatively to it, with an average of 5% drawdown on SPY right here. And in a lot of major events, I would expect to see more. Because these are not that big of events. Like Ronald Reagan shooting. That's when Ronald Reagan got shot. That's not too important. But Iraq's invasion of Kuwait, it dropped 17%, 16.9%. I would assume we'd see something similar to that, or the Iraq invasion, or any other major war, you know? Not as big as Pearl Harbor, Second World War, but we don't know as well. So the initial phase is categorized by explosive, aggressive movements. Imagine this candle right here, all the time, all over the place. That makes it very risky to hold. You can get gapped out, but also potential for very high gains. There is also capital preservation. What does capital preservation mean? Is that when there's a lot of volatility, especially inside of SPY, since with SPY, people will sell to preserve their capital. They're worried about, that's how the average investor thinks. You shouldn't think like that. But when there are these events, people sell off to preserve their capital. That also reduces liquidity, so we could see an increase in spread in pairs because the liquidity preservation aspect of it would likely be the same outside of huge pairs like Euro USD. It's just too much liquid in it. So you could see it being harder to trade just because of the spread. High spreads are terrible to trade. And lastly, for the shock value portion of it, I've noted down that volatility goes over the direction. And what do I mean by direction? So we have our ranges, our SR areas. There's a directional approach. You kind of lose that. We can't really sort of do the WT, CT type of trades with expectations. CRs become kind of useless because of that. And it becomes a very, very BO related market, like we observed later, just by the threat of war. I mean, earlier, not later. Earlier, when we were trading in July, August, when Trump was talking about bombing the shit out of fucking Venezuela. After that, after a little bit of time, like everything else, it gets stabilized. So ranges start to reform. They find a new baseline. We've seen that with the Ukraine war. where initially the markets reacted quite violently to it. Here, let me show you 2022. This one is not. Let's have a look at SPY. Let me go in full. So yeah, since 2022, SPY went on a downward spiral, and it was down for years. You could have entered in January 2022 and still been down in fucking January 2024. So that's not good. Unless you know how to invest, then I mean it wouldn't matter that much. This is gapping, by the way. SPY gaps all the time because of how much it closes. The currency markets we're trading are open a lot more, so we don't see these violent gaps. But what we'd be seeing would be a return to the normal. It would find a new price range. It would still be a full-on BO market. Keep that in mind, especially as it's heading into the new ranges, and risk premium expands. What does that mean? I don't know if you're all familiar with the risk premium term, but what I'd say to simplify it is that the average investor wants more out of their trade. Risk premium, basically, premium for the risk taken during those unstable periods of volatility, as the market is now refinding its range. And my expectation with that for you as a trader would be to see that traders are looking to gain more. When they're looking to gain more, ranges become larger. These minor SR areas we draw in between would likely become irrelevant, and we'd be playing bigger ranges because that's what other traders are doing. However, we would not be entering the bigger ranges in that sense, because if the market is re-emerging with bigger ranges, more volatility within those ranges, we'd still be doing our standard max 2R on entries. So that wouldn't affect us that much, but the ranges would be quite nice to trade, to put it that way. And as mentioned, wide but defined ranges. We'd have pretty clear ranges, and this is something I remember myself. Not too many years ago, it was like that. And mind you, these periods don't last that long. The initial shock period, I mean, you can't really know. It depends what the fuck happens. But with the Ukraine war, I mean, it was pretty noticeable for, let's see, let's have a look. Yeah, here it is. So you can see these ranges are pretty violent. These are big ranges, but they do slow down after not too long. So at the end of 22, it started March 22. So within the year, it was more or less back to where it was. But as you can see here is the increased premium people want for the risk taken. But for our case, if we were trading this, if this was a BO, for example, long here, you would still be doing the normal 2R on entry, like this. So yeah, or 1.5 if you're going CT. So we'd still be trading that. You don't want to try to ride all these ranges like that, do some dumbass shit, 5R on entry because it's a volatile period. No, don't do that. Let's get back here. Next up is section dispersion increases. So that just means that this goes well into, this overlaps a lot with investing. That is, certain sectors will do very poorly during that period, while other sectors will profit a lot of it. A classic example would be on January 7th, was it? When Hamas attacked Syria, there was a 5% jump in Lockheed Martin because they would expect to get more military hardware out there, more military supplies, while other sectors did not see that same reaction. So there's dispersion between industries. Again, I've already mentioned this, but the range trading would be greater. We would see what we talked about a few months ago, going back to like July or later, even September, how the market moved over from BO to a CR market with continuations jumping in. In a ranging market, CRs are very nice. And in the high volatility, explosive, uncertain markets, you'd see earlier, it will be very much a BO market. And mean reversion. Have you ever heard about that before? Reversion to the mean is that the market would be trying to find its new price because everything in the market eventually gets priced in. Even in World War II, the markets got priced in. It wasn't like SPY just tanked and tanked and tanked and tanked and tanked. No, it didn't. It got priced in. Even in World War II, everything eventually gets priced in, and you get a reversion to a mean, and we'd have a range again. And relative value setups, not that important for us, but I just wanted to keep it in there, and I'm gonna bring all of this back to because I put a investor section in the back that we're gonna talk about as well. However, regardless, the relative value setups would be the same for us, but for other traders, they would be looking for more. That's a very natural reaction as well. When there's aggressive movements, people want to capitalize off of those aggressive movements. If something is tanking down, right, people are going to want to catch that as much as they can. However, with the my trading strat, as you might know, there's a max 2.0 R on entry. You don't do more than that. I call those dreamers. Don't find those profitable, very, very low win rates. They usually go to hell. What you want to do in a period like that is get your SL to BE and then do TP extensions, full extensions. And you might end up with trades like this. So this was a full extension 5.0 R trade that I didn't enter, by the way, because at my monthly limit. So now, after all of that, we'd get into the normalization stage. Everything would be priced in, and the news cycle would more or less become background noise. It wouldn't matter what happened. If what you mentioned happened, a war broke out, conventional war, between Venezuela and the United States, updates from the war would have less and less and less of an effect. Yeah, like I mentioned here, war becomes background variable. Becomes a background variable. Yeah. And fundamentals regain dominance. So the fundamentals we'd be looking at for us, I don't mean that as in looking at news fundamentals, but the fundamentals for looking for setups, setting SRs, drawing, our painting, our strat, and all that, and conventional fundamental analysis. Just not that we do much of it. We look for headline risk. Would more or less become normalized. And what you often see is volatility compression, also known as what I like to call congestion. You can see periods of slow, non-directional approaches depending on what happened. And mind you, I'm talking about all of this in isolation. There's always a lot going on. Could be another war breaking out. Could be some fucking new regulatory reform that pumps up SPY something very bullish, tax reform, trade deals. The deficit could get reduced in the U.S., which would be very bullish. That would be an expectation that it's good because inflationary spending, all the deficit spending, the market would expect rate cuts again, SPY pumping, dollar index going down, and we'd see ranging for that. And in the end, I've noted the trend re-emerges. Re-emerges. Yeah, should have said re-emerges. Which just means that we'll be back where we are right now. Scary ass event. Some 9/11 stuff happened. Panic, panic, panic. Then market doesn't know where to go. And then in the end, we'll be back. Now, let me get into the investing aspect. I've noted down long term because all investing should be viewed that way. You're not swing trading, you're not trading when you're investing. Those are two completely different things. But things to keep in mind is that initially when things happen, there's a sell-off. And that is almost universal, as I've noticed. And it can take days to recover from it, depending on what happened. Saudi Aramco drone strike, I remember that. 41 days for SPY to recover. This Iraq invasion of Kuwait, larger event, right? 189 days. The Tet offensive, 65 days. And the Pearl Harbor attacks, World War II, 307 days. And overall, on an overall basis, it always reacts with panic, okay? So volatility is front loaded. It is always like that. It is always like that when you're investing. It comes in priced in just based on the expectation. So the market thinks something is going to happen. Trump says, you know what? We probably should invade Venezuela in a week. We probably should do that, The SPY is most likely going to react very negatively to that. It's front loaded. However, keep in mind, Trump says those kind of things a lot. So it's priced in, which could actually make it more volatile. Because if people just see his talk as talk and it doesn't price in, and then something eventually happens, it'll hit harder. So, next thing I've noted down is that the markets adapt faster than narratives. And what I mean by that, like, what the fuck? So, there would be a war narrative for all of it. There would be news about what's happening, what might happen, just the whole news cycle of it all, angling, politics, talk, the whole narrative of the scenario. But the market would see through all of that. The market doesn't care. That's the thing about the market. It doesn't care what you think, what you believe, what these goofy ass analysts with they're just activists are assuming what will happen and this and that. No. The market's going to stabilize in its own way. And let me get to the last point here. Long-term trend driven by growth, policy, and earnings. So if you look away from wars, and I'm done with this. Let me save this. If you look away from wars, it is not really a factor long term. Because if we look at SPY, it has had all these recessions, credit cycles, wars, dog shit things happen, and the overall trend is up. That's very, very clear, right? This is very clear when you look at it like that. So why should you care about that? Because if you read the book recommendation I dropped here in the investing guide to read The Intelligent Investor by Benjamin Graham, you should understand that these are periods where you should buy if you're investing. These are very good periods. As long as you're not like some panic based motherfucker. I mean, fuck you anyways then. You can't invest if you're just, oh, it's going down, I have to sell. What if it goes lower? Idiot. No. So what happens is when you buy SPY, there's a dividend yield on it, right? There's dividend yield on all those, on all those blue chips. When SPY goes down, they don't cut dividends, and it is per share. So not the price of the share, but per share, how many shares you own. So your dividend yield as a percentage measure will go up. So if your portfolio is on a drip, in index funds always are, which I always recommend beginners to buy. DRIP is a dividends reinvestment plan. They just buy up more shares quickly. And it is also an opportunity for you to get your average price down. And if you believe that things are going to stabilize and modernize, productivity is going to go up, things are going to be good again, then you should definitely just average into it. Recessions, wars, anything else that drags it down shouldn't be anything that affects how you trade beyond looking at it like a discount. You should learn to change the lens you're viewing it. Okay? When the SPY is down, you shouldn't be looking at it like a trader who says, fuck, my portfolio is down. Fuck, shit, it might hit sell loss. You're not going to have a sell loss when trading. The only thing it really means is that it's discounted. Most likely, the market cap is below what it should be. So it is very eager to rebound off of those levels because the fear-driven investors are eventually going to come back. When it starts to re-emerge, they're all going to jump in on that hype as well. So wars, buying in recessions, that kind of thing, buying the dip, the good old buy the dip, is not bad advice when you're investing. Even though you should always try to get something monthly in. If you can get something extra in during down periods, that is always great. Because, I mean, realistically, unless you have some kind of conspiracy theory that the whole world market is going to collapse, SPY is going to go straight to zero, then it doesn't really matter. Even then, you should be buying. Because if SPY goes to zero, your money is not going to be worth anything regardless. The whole fucking economy is done. Only thing that matters then is shotgun bullets, bro. So there is no reason to worry about it. That's the whole point I want to draw home with it. Sorry. So with that said, that's all I've got. That's all I can remember now. I hope this was a good explanation. I hope you're happy with the answer. I did some research, tried to give a proper one for this one. I did make bullet points to remember to bring up certain things, and I hope this brings clarity. If not, you can just ask in the Discord. So I'm going to end it here, and I'm also going to say that if you are interested, if you want to hop in the Discord as well, it's linked in the description of my YouTube videos. There's nothing for sale in the Discord. It's not monetized or anything like that. This is not, I mean, there's not even ads on the YouTube videos. I make money trading, okay? Not doing any of that other bullshit. So, thank you for watching, and bye-bye.